Matt Orton joining in, his Chief Market Strategist, Raymond James Investment. Matt, very good morning to you from where we are, and always great to have you on the show. I'm just trying to understand if the optimism we're seeing is something that could last, because it's one set of data. The backdrop of tariffs still remain. This morning, news coming in that Trump wants to apply tariffs on movies made outside the United States.
Good morning. It's always great to join. And I've always been more of a glass half full person throughout all of this uncertainty that we have. And I think a lot of the reversal that we've seen over the past couple of weeks, I mean, we've just had 9 consecutive up days on the S&P 500. First time that has happened since November of 2004. So there's a lot of, I think, reversal, hope that we're going to start to strike trade deals, that the worst left tail scenarios are off the table. There's going to be some key events this week that we have to pay attention to. Number one, the S&P 500 is approaching some key technical resistance levels. So can it hold its own? Can it break through some of those levels? We're going to see. And I think the most important detail is going to be the Fed meeting. And so on Wednesday, we'll hear from Powell. And I think that Powell is going to strike more of a hawkish tone. I think interest rate pricing, the expectation for cuts is a little bit ahead of itself, given that the data continues to hold up fairly well. We're seeing decent earnings, much better than feared across the S&P 500 companies as well. So I think amid that backdrop, the Fed's going to be very reticent to try and broadcast more cuts that are coming up. So I think we're going to have some adjustments, but I do think that dips are viable, and I would wait for dips to start to put more capital to work in this market.
Matt, that's an interesting perspective that you're putting forth as well. Good morning. This is Hiral on this side. When you talk about Powell being more hawkish from here on, what would that actually mean for the money market, taking into consideration the way the dollar index and the bond yields are moving? Because that, again, becomes absolutely imperative for emerging markets as well.
Hey, good morning, Hiral. And that's a really good point. Part of the reason that emerging markets have worked so well this year is because the dollar has been so weak, and understandably so, given the position that tariffs and that uncertainty has created and capital flows happening around the world. I think that dollar weakness, we're seeing a lot of dollar weakness again overnight tonight. And I think the market could be in for a little bit of a rude awakening, some reversal potential, given more hawkish comments from Powell. But I don't think the downward trend is over. So again, I think the strength that we've had, particularly in markets like India, supported by really pretty good earnings across a number of key companies, I think you want to keep that more optimistic bias to your positioning in the market, but wait to put some more money to work, because there's going to be ups and downs. There always are in this market. And I think investors really should be looking to use downside opportunistically rather than chasing upside, just because there are a lot of potential near-term speed bumps that could give you a better entry point in the current market.
Hi, Matt. Alex here. Speaking of downside, and I realize you and I are similar. I think a lot of people choose to look at the glass half full. But I was reading a comment over the weekend, and it says there appear to be similarities to the Roadrunner cartoon, in which Wile E. Coyote keeps on running long after the ground has disappeared beneath his feet, ahead of the inevitable moment of realization when gravity kicks in. So the writer is talking about the possibility of a cliff edge kind of a situation, and we did see those payroll numbers come through. What if there's a dramatic shift in the data as early as this month, or perhaps next month? What happens then?
Yeah, hey, Alex, good to see you. And I think it's a question I asked myself when I've spent a lot of time over the past month talking to clients multiple times every single day. And a lot of them have been a little bit more glass half full, which has been surprising to me. I think everybody learned what happens when you take money out of the market like you did in 2020 after COVID, only to have a recovery. We know there's going to be damage as a result of tariff policy. We know that economic growth is going to slow. Obviously, Q1 GDP results are an anomaly just because of front running of tariffs, but growth is going to weaken. I think the key, though, is when you look at all of the data that we have, payrolls data especially, because jobs are so important to sustaining the consumer in the US. what we are seeing is that the jobs market remains strong and that the base from which we're going to have some weakening is very, very elevated. So I think that provides some insulation. Plus, you have the White House continuing to make pivots with respect to policy and really listening to the cues from the market with respect to where to pull back and where to remain firm. I think that's encouraging. I think that takes those worst left tail scenarios, that proverbial cliff that you just mentioned, off of the table. And the big question now is just how much does the hard data actually pull back? I think based on what we're seeing, based on all the CEOs and management teams I've been talking to through this earnings season, I'm not getting the sense that they think this economy is completely derailed. Some of the growth is just delayed, it's being pushed back, but there's still the hope that when we get policy right, plus deregulation, which the administration is starting to focus on, plus making permanent some of the tax cuts, all of that provides some offset. So to me, when I look at the market, the key is being selective. I don't think you want to own the full market. You want to own high quality companies that are leaned into secular, long-term, durable growth themes like artificial intelligence and the more AI tangential plays. Those are the places where we're seeing continued strength, trading at really big discounts and still today trading at big discounts.
You know, the other big factor, Matt, which I think we should talk about a bit and try and understand what the impact will be, is what's happening with crude. The almost overnight plunge after OPEC Plus has made it clear that there's going to be more supply coming in. Benign crude prices seen in the context of an emerging market like India is another positive buffer?
Yeah, I think that's right, Tamana. I think weaker crude prices are certainly a positive for emerging markets, and India in particular, especially when you overlay a weaker dollar, and the fact that I think India, along with Japan, South Korea, are probably going to be the first trade deals that get announced over the coming week or 2 weeks or so. So I think that all bodes very, very well. I don't think that the weaker oil prices, at least right now, based on what's happening from OPEC, I don't think they're a harbinger that there's worries that economic growth is going to fall off a cliff from a global perspective. I think it's very much related to supply-demand dynamics. The market's very reactionary right now, so I wouldn't read too much into it, except for the fact that I think we can count on oil prices to be a little bit more weak. Don't want to own energy companies right now in the US, but I do think it spells very, very good opportunities in emerging markets. And India is one that I have been telling clients is a ballast with respect to a lot of the uncertainty that we have from tariffs, given its insulation from US trade and also the valuation compression you had from the 15% pullback, a couple months ago. So I think there's still a lot of opportunities. And again, we're seeing that reflected in earnings strength, especially from banks, financials. That's really, really encouraging to me going forward.
Yeah, and that's what we want to ask you about as well. I guess that you've adjusted your top picks based on what you've seen in the earnings fine print. So what stands out to you at this point, Matt?
Yeah, so Alex, ICICI Bank is one that we've talked about in the past. That is by far my largest overweight in India right now. This is the name I continue to accumulate on any weakness. Earnings once again were best in class. You continue to see margin expansion. You continue to see a solid wealth management business. It's just an incredibly well-run company. HDFC Bank, though, looks really, really good. This is one we talked about when I added it later last year on some weakness. And I continue to like what earnings have spelled. You had margin improvement, which is good, loan book growth. Those are all really, really encouraging signs and healthy execution from the management team. So I like those a lot. And then when I look at other names that I've been adding to positioning, Bharti Airtel has been another, second largest carrier. It's got a lot of exposure not only to India, but to Africa. Again, it's a standout operational story where there's a big margin improvement and lower CapEx because we're kind of through the 5G CapEx cycle. So those are all really, really interesting. A name I have my eye on right now to potentially start to reaccumulate is Mahindra & Mahindra. Again, they report earnings today, so I'll be curious what we're going to hear from the management team. But what I like about what I have seen so far is that they're gaining market share in farm equipment. They're in a great cycle with respect to SUVs, potential accretive mergers taking place, and again, best-in-class management team that's executing. And I think it looks very, very attractive based on the pullback we've had over the past month or so.
Yeah, Matt, good names to talk about. Thanks so much for joining us this morning, and perhaps we'll check back to you after the M&M numbers to see whether you continue to be optimistic.
Sounds good.